Hello, and welcome back to my channel, Dividend Investing, your one-stop shop for all things investing and personal finance. Dividend investing is a strategy where investors focus on stocks that pay regular dividends. The goal is to receive a steady income from the dividends, which can be reinvested or used to supplement the investor's other sources of income. Dividend investing has a long history and has been a popular strategy for income-seeking investors for decades. In this video, we will explore the origins of dividend investing, its advantages and disadvantages, and various strategies to implement the strategy effectively. The concept of dividends dates back to the early days of corporate finance, where companies would distribute a portion of their profits to shareholders. In the early 20th century, dividends were the primary source of investment income for many investors, and dividend-paying stocks were considered a staple of any investment portfolio. However, in the 1960s and 70s, there was a shift in corporate finance towards share buybacks and reinvesting profits back into the company, rather than distributing them as dividends. This shift was largely driven by the rise of the efficient market hypothesis, which suggests that investors can't beat the market by choosing individual stocks. As a result, many companies stopped paying dividends, and investors shifted towards growth stocks, which were expected to increase in value over time. In the 1980s and 1990s, there was a resurgence in dividend-paying stocks, driven by changes in tax laws and the declining popularity of growth stocks. In the early 2000s, dividend investing became more popular as investors sought out reliable sources of income in the wake of the dot-com crash and the 2008 financial crisis. Famous dividend investors include Warren Buffett, who has famously said that if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Another example is John Paulson, who is known for his successful bets on the subprime mortgage crisis and is a strong advocate of dividend investing. For example, Warren Buffett's Berkshire Hathaway holding company has significant investments in dividend-paying stocks such as Johnson & Johnson, Coca-Cola, and Procter & Gamble. These stocks have been held for many years and provide a stable source of income for Berkshire Hathaway. So, what are the benefits of dividend investing? Well, firstly, one of the primary benefits of dividend investing is the ability to generate a steady stream of income. Dividend-paying stocks can provide investors with a reliable source of income, which can be reinvested or used to supplement other sources of income. Another benefit is the potential for long-term growth. Many dividend-paying stocks are established companies with long track records of financial stability, making them less volatile than growth stocks. This stability can provide investors with the opportunity for long-term growth and capital appreciation. Dividend investing can also provide a sense of security during market downturns. During bear markets, dividend-paying stocks can provide investors with a reliable source of income, while the underlying stock prices may be declining. This can help investors weather market downturns and provide a sense of security. However, it's not all sunshine and roses with dividend investing. There are also some risks. One of the primary risks is the potential for dividend cuts or suspensions. If a company's financial performance declines, they may be forced to cut or suspend their dividend payments, which can result in a decline in the stock price. Another risk of dividend investing is the potential for limited growth opportunities. Because dividend-paying stocks are often established companies with a long track record of financial stability and steady growth, they may not offer the same growth opportunities as growth stocks, such as Apple or Amazon. This can limit the potential for long-term capital appreciation for the average investor. And lastly, dividend investing can also be subject to market risk. Even though dividend-paying stocks are often considered less volatile than growth stocks, they can still be subject to market fluctuations and economic downturns. This can result in declines in stock prices and reductions in dividend payments. So, if you're an investor and you fancy dividend investing, how do you go about doing it? Well, there are several strategies that investors can use to implement dividend investing effectively. One strategy is to focus on companies with a long history of dividend payments. Companies that have consistently paid and increased their dividends over time may be more reliable than those with a short record of dividend payments. Though remember, a long history of dividend payments is not a guarantee of future. Another strategy is to focus on companies with a high dividend yield. The dividend yield is the annual dividend payment divided by the stock price, expressed as a percentage. Companies with a high dividend yield may provide investors with a high level of income, but they may also be susceptible to dividend cuts or suspensions. Investors can also consider investing in dividend ETFs or mutual funds. These funds invest in a diversified portfolio of dividend-paying stocks, which can provide investors with exposure to a broad range of companies and industries. This can help mitigate the risks of individual stock picking and provide a more reliable source of income. When it comes to dividend investing, investors have the option of either picking individual stocks or investing in dividend ETFs or mutual funds. Each approach has its advantages and disadvantages. Individual stock picking can provide investors with the opportunity to invest in specific companies with a long history of dividend payments and strong financials. However, this approach can also be more risky, as individual stocks are more susceptible to market fluctuations and economic downturns. Investing in dividend ETFs or mutual funds can provide investors with a diversified portfolio of dividend-paying stocks, which can help mitigate individual stock risk. However, this approach may not provide the same level of potential growth as individual stock picking, as the portfolio may be more weighted towards established companies with limited growth opportunities. So, in conclusion, dividend investing is a strategy that has been used by investors for decades, and it can provide a reliable source of income and potential for long-term growth. However, it is important to understand the risks associated with the strategy, including the potential for dividend cuts or suspensions, limited growth opportunities, and overall market risks. Investors can implement dividend investing strategies by focusing on companies with a long history of dividend payments, high dividend yield, or by investing in dividend ETFs or mutual funds. While individual stock picking can provide investors with the opportunity for higher potential growth, dividend ETFs or mutual funds can provide a more diversified portfolio and mitigate individual stock risk. Overall, dividend investing can be a valuable strategy for income-seeking investors, and it is important to understand the benefits, risks, and strategies associated with the approach. By implementing a sound dividend investing strategy, investors can potentially generate a reliable source of income and long-term growth in their investment portfolios. And that's it. Thank you for watching. I've been the Dividend Investor. Don't forget to like and subscribe if you enjoyed this content, and I'll see you again next time.